Now let's work on question 2. I'll read the problem here, complete these pro forma. Actually not going to have any ratios on this exam, took too much time. For data. So we'll download that, complete our final model here. And again, please don't insert or delete any cells, rows, or columns. Just makes it much harder to grade. And so we've got our history here. We need to calculate our ratios, drivers, and forecast. Now I'm going to go to sales about a gazillion times today. So I'm going to remember that sales are on row 15. In fact, you know what I'm going to do is say sales are on row 15. Let's see if that saves me any time today. So D15 over C15 minus 1 gives me the sales growth. D16 over D15 gives me the COGS of sales. And I'll bet 2 lines below 16 is 18. Sure enough, SG&A is on 18. D18 over D15 gives me the percentage of SG&A. Wouldn't hurt to check these, but we'll move pretty quickly today. So depreciation divided by the average net fixed assets gives me that ratio. Interest expense, not net interest expense, but interest expense divided by the average debt. And it's okay that one of these is blank. It'll just mess up our ratio slightly in the first year, but it will work fine after that. So the interest income over the average cash gives us a ratio, and the non-operating expenses over D15 gives us a ratio. The effective tax rate is the tax provision divided by the taxable income, and the payout per basic share is dividends divided by shares. Share growth is shares over last year's shares minus 1, and diluted as a percent is this over that. So we have some ratios. We can copy them forward. We could come in here and populate all these cells by saying equal the cell before it, Control Enter, but that kind of messes up this formatting, which is going to confuse me later. So I'm going to undo that, and I'm going to say equal the cell before it, copy, and this time I'll just paste the formulas. Now to forecast, last year's sales times 1 plus the growth rate. Cost of goods sold is sales times the ratio. SG&A is, that's a subtotal. SG&A is sales times the ratio. Depreciation, another subtotal. Depreciation is the ratio times average of net fixed assets. Let's go find net fixed assets. And then we can subtotal that. And then interest expense is the ratio times the average debt. And interest income is the ratio times the average cash. Again, we're not worried about those blank cells at this point. We can subtotal that. Non-operating expense, other non-operating expense times F15 because sales are on row 15. And then we can subtotal. Now this subtotal is tricky, right? Because we need to start with EBT and then pick up our net interest expense and our non-operating expense. Close the parentheses. Tax provision is the tax rate times earnings before taxes. And one last subtotal before we do dividends at $1 per share. We don't have any shares yet. but we will in a moment. Those shares are growing. Oh, growing at 1 plus this percentage. But we also need to pick up any shares that we add. If I invest, let's see, down in row 80, stock issued. So if I issue $400 million of stock divided by $22 a share, that will give me the additional shares from that manual issuance that I add to this annual increase. And that gets me to bump that stock count up to 81 million shares. And if we assume that the same proportion is diluted, then we get that number. Now we should be able to forecast this control. Whoa, that was not control. Should be able to come up here and control R. And we're not worried about these divided by zeros because we're about to go in and populate the balance sheet. Now we don't have any ratios on these manual entries, but we do on some of these, and this one's days of sales. So if I wanted accounts receivable divided by days of sales, days was on 15, so this time it's E15. That's a year of sales, but I want it to be a day of sales, so I'll divide it by 365. And I do need those parentheses, I think, in this case. Maybe not. Yes, I do need those parentheses in this case. And so the inventory is similar. It's going to be inventory divided by days of COGS, which would be a row later, so that would be E16 over 365. Now that's an outflow, so it gave me a negative. I'm going to go back and fix that. And then other current assets is going to be a percentage of sales. Don't confuse it with non-current assets. Go and grab other current assets as a percentage of E15. And then other non-current assets as a percentage of E15. Accounts payable in days of COGS. So accounts payable divided by, that'd be E16, right? Divided by 365. Other current liabilities as a percent of sales. Oh, those payables, that was an outflow as well, so we need a negative sign. Other current liabilities as a percentage of E15. Good thing I put that 15 up there, isn't it? It saves me a lot of scrolling. And if you're actually patient enough to sit through this video, it saves you a lot of getting seasick. So other non-current liabilities as a percentage of E15. And same thing again here. I don't know. I'm going to try it, see if it messes up any of my formatting. Control Enter did not. It kept these in days, those in days, everything else in percent. So got those brought forward. If we were doing a project, we'd put more thought into these drivers, but for an exam problem, we'll just carry it forward. Now we can go to cash. Cash is, of course, going to come from the very bottom of the cash flow statement. Same year. Accounts receivable, those are in days, right? So if we have 10 days of sales, which is in F15, but we need to convert that to days of sales. See if we're on trend there. I would like to look at those numbers, see if I'm on trend. Inventory is going to be similar. It's going to be the days of COGS, which would be F16, a row below sales, divided by 365. I feel like I got a negative sign wrong there. It's because those COGS are outflows, so I need a negative on that one. And then other current assets was probably percentage of sales, wasn't it? Yes, so times F15. We're going to do a little bit of subtotaling. Not going to grab cash, but we're going to grab everything excluding cash. And then our fixed assets is whatever they were before, plus whatever we invested in them. our accumulated depreciation is whatever it was before, plus however much we depreciated. And our net fixed assets are the subtotal of those two. Other non-current assets are, what are they? Other non-current are that percent of F15 sales. And we can try to subtotal those. So that would be cash, other current assets, book value of assets, and other non-current assets. Okay, and then our accounts payable, that's in days of COGS, so times F16 over 365. Other current liabilities, as a percent of sales, so that's F15. Subtotal those. Debt is whatever it was before, plus however much we issued. And then other non-current liabilities, better get the right ratio. That was a percent of sales, so F15. Subtotal those like that. Make sure we're still on trend. Don't know why that one's negative. I think I left off a negative sign because that was an outflow upstairs. Okay, now I'm a little bit more on trend. See that debt being issued. Okay, that feels better. Stock is just going to be however much we had before plus however much we issued plus however much we grew up here. We grew the previous stock amount, number of shares, times 1% times a stock price, and then accumulated retained earnings, just accumulated this year's retained earnings. And so we can add up our total equity and our total liabilities plus total equity. And of course we're not balanced because we don't have a cash plug. So let's go get a cash plug. That cash is going to begin with net income. We're going to add back, I'm just going to cheat and peek at depreciation's on row 20. So we're going to add back F20. Subtract off an increase, so I'm going to need a minus parentheses sign, this time for current assets. And an increase in current liabilities. And sum those up to get our cash flow from operations. We're going to need to subtract off any increases in our gross PP&E. Should be exactly that amount that we invested, 100. Got used up, so it's negative. And then subtract off any increases in other non-current assets. Other non-current assets. And add in any increases in other non-current liabilities. Seems to be a pattern here. Sum those up to see how much cash we used in investing. It was almost all that capital we spent. And then any increase in debt. It'd be tempting to pull it from here, but let's pull it from here to be safe. Any increase in stock, same thing. Here we really need to come up here. We wouldn't get that 1% growth from above. And then we want to subtract off any dividends. So those dividends are already outflows, so I'm not going to need a negative sign. Just put them right there, and they'll show up as a use. And then we can say sum up, oops, this one, and this one. Grab last year's cash flow or cash off the balance sheet, the end of last year, beginning of this year. Add those two together. See if we got lucky. We got lucky and it balanced. So we're about 15 minutes into this and a couple of practice runs. Took me 3 to 5 minutes to fix things that didn't balance. There's one that didn't balance. Let's come copy this over with a Control R. And then we want to do just about the same thing. It's tempting to use those numbers again, but I like to redo it just kind of as a check on my work. Net income, the first thing we're going to do is add back depreciation on F20, so equals minus F20. And then subtract off any increase in current assets, excluding cash. There we go. Add in any increase in current liabilities, excluding debt. Subtract off our increase in gross PP&E. That's a capital that we spent. And subtract off any increase in other non-current assets. Forgot my parentheses on the front end. Then we want to take an increase in other non-current liabilities. And then here's something we haven't done yet. I like to leave this tax rate blank so I can check something. I'll show you in a moment. So I'm going to have that tax rate that we'll put in there in a minute. Actually, it's going to be, we want to add in the 1 minus the tax rate times the after-tax interest on debt, or the interest on debt. We just made it after tax. So here's our interest expense. That's an F22. F23 is going to be the interest income. If I want to add that back, I'd better make it negative. Let's do the same thing here. Let's say 1 minus tax rate. Did I say F23? And again, I'm going to want to make that negative because if I just hit OK like that, it's going to add in that interest that we made. And what we're trying to do is back out the effects of financing. So we need to subtract that one back out. Now, why I like to leave those there is I can check and say, is this change that I'm making, it sums to 31.3, and we're saying that that's a positive cash flow that we're adjusting for. Compare that up here to this negative 31.3. So we're backing out that 31.3 financing cost. And that's one of the reasons we do this free cash flow is to back out the financing. Okay, or it's like the cash flow, it just doesn't include financing. So that part we're backing out. This part, let's add up and see if that adds to 107.6. If you look at that, it's operating and investing income. So let's see if this and this add to 107.6, and they do. So I've got a lot of confidence in this number now. I'll add it up. And I'd like to do a Control R, but as you know with this model, that silly line comes across. So I'll undo that, copy these, and do and paste special formulas. Then we get our free cash flow forecast. Excuse me. We'll go get our WACC so we can discount that free cash flow forecast back to time 0. Now the note here says use the first driver for the best, and we know our drivers are negative, so I'll put a negative sign and come up here to the yellow, pull that first tax rate. We don't want to use the last historical tax rate. We may have had some weird tax things going on, so we want to use that first driver there. For the cost of debt, it also says to use the first driver. And again, that ratio up there is going to be negative. So I'll start with a negative and grab that one. And it says for debt, use the last year of history. So we have to use the actual ending amount of debt that we had the end of 2020. And we're already given cost of equity. We wish we had time to use the CAPM model, but we don't. And then for equity, we're told to multiply diluted shares times the share price. So diluted shares at the time of the valuation times the share price. Okay, and so it shows that we have about $750 in debt, twice that much in equity. We can calculate the WACC. I'll show you a little trick. If you'll do Shift F2, or however you edit a comment on a Mac, I would Google that. Copy that little formula. You can come in here, hit F2 and paste it. And then tax rate, cost of debt, cost of equity, oops, just double click on the variable, not the whole thing. I can't click on cell H134, but I can click on 133 and go down arrow. Get the debt. And again, for equity, I'm going to click on the cell above it and hit down arrow. Let's see if that makes sense. 14.4 is a little closer to 20 than it is to 5 because I'm more weighted by equity than I am by debt. So, all right, that passes a reality check. Now it's time to get a terminal value. We worked really hard to get these, but to get that terminal value, I'm just going to use this little equation. I'm going to hit Shift F2 again to edit that equation. Copy, escape, paste. And let's see, for this, that's my terminal cash flow. This is my long-term growth rate. It's my weighted average cost of capital and the long-term growth rate again. Now to get the implied multiple, it's just the terminal value over the free cash flow. So the terminal value over that final free cash flow gives me a 9.1 versus a 10 assumed over here, so that's reasonable. Let's go over here and do these two while we're at it. So this one's simple. It's just the terminal free cash flow times the multiple. So that times that. And then to, that's one we're going to want to get a formula for. So Shift F2, copy, paste, edit. We'll grab the WACC, the terminal value, that final free cash flow, the terminal value, and the final free cash flow. And that looks same order of magnitude as our assumed long-term growth rate. So our implied numbers look okay. Now let's get the present value of the cash flows. In PV function, we're going to discount at WACC. We don't care about any initial times zero values, so we can go straight to the future values. But we do need to adjust that because we're told assume that the cash flows are at the middle of the year and no other assumptions. So that'd be 1 plus WACC for half of a period. Did something wrong there. In PV of those. Oh, look at how bad those are. Goodness. Just about missed that. So when I looked at that, I didn't put absolute references on that one or this one. Good thing I caught that. Now if I Control R, those look a lot more reasonable. And that looks a lot more reasonable. And I can come over here. The PV of the cash flows is going to be the same regardless of which method I'm using. So I'm going to say equals. And then the PV of the terminal value is not. I have to take that terminal value and divide it by a PV factor. Divide it by 1 plus the interest rate to some number of periods. Now what number of periods? I always like to go from here minus this. I don't really have to think about it. It would be 1, 2, 3, 4 periods, right? But since these things happen in the middle of the year, I don't really want 4 periods, so I'll reduce that by half a period by subtracting off 0.5. And then that's the PV of that terminal value right there. What I'm going to do is Control A, copy, come over here and paste that in. And the only thing that changes in all of that is what I'm using for terminal value. So then I can say, okay. The enterprise value should be terminal value of the cash flows plus the, PV of the cash flows plus PV of the terminal value. I need to add in any debt that I had at the evaluation point. Add in the cash. I'm going to subtract off the debt in E65 minus E65 to get to an equity value. Now, enterprise value, that formula is the same. I'm going to add up those two. The cash is exactly the same, and the debt is exactly the same for both. And then the formula to add the three items up is the same, so I can copy that cell. And then the diluted share count. At the time of evaluation, 63.7. So I'll say equal that. Then if we take all that equity value and divide it by the number of shares, diluted shares, we are finished. So a little bit under half an hour there. If you double that for exam conditions and maybe a mistake or two along the way, kind of leaves a lot of time on this problem. Might want to save this one for last and just get through what you can of this problem, which I'm sure will be all of it for you.